What's happening, traders? Welcome to another video. It's Emmanuel from LiveFree, and today we're going to be diving into the accumulation and distribution pattern recognition part one. This is a video based on one of my favorite trading strategies that I have developed over a period of time. It is one of the strategies that gave me a lot of confidence in my trading journey. It was probably the first of its kind that made me feel like, wow, Emmanuel, you can really do this, right? You can actually become consistent. It's not just the strategy itself, but it's the approach that I took to developing this strategy in particular. That's why we have the pattern recognition as part of the overall process. And I believe as a trader, our goal is to be able to recognize patterns, to be able to really see what we're looking for, because that's the only way that your brain can actively execute without feeling the stress of, oh my God, am I going to lose money, whatnot. In this video, I'm going to be breaking down the accumulation and distribution strategy step by step, going over some, samples, going over some examples, going over how you can utilize it in the market and make profit. I have made thousands of dollars from this particular strategy, and I continue to make money from this strategy, and not just making money, but it is extremely consistent. And I'm going to walk you through the process that you can see that is simple. And this is part one. Some videos will be released in the next couple of weeks, and it will be just shorter clips of the samples and whatnot. So stay tuned for that. So make sure you watch this video to the very end, so when the next parts come out, you can definitely understand what's going on. But this is the first one of its kind, but we're not going to waste too much time on this. Hope you enjoy the video. Let's dive right into it. Welcome to the accumulation and distribution pattern recognition series. This is going to be something that just a couple of videos. I haven't determined how many videos I'm going to be putting out yet. This is the first one. I've talked about this in the channel previously, as you guys would see in some of the other videos, but this is one of the strategies that I use when I am trading gold. It doesn't just work on gold, it works on other currency pairs as well, commodities or whatever you're looking at. In this video, I'm going to be breaking down the concepts that allow this strategy to be effective and the foundational aspect of it. I believe that as a trader, your goal is to build recognition, right? The goal as a trader is for us to recognize patterns, right? You are visual, you're seeing things on the chart consistently, and you need to be able to act on those things that you see. So when I thought of, putting out a video that would be beneficial to the viewers and the audience, like something like this. And one of the things that's really helped me over my trading career, helped me become the trader that I am today, is doing unconventional things. I spent a lot of years backtesting and using backtesting simulations and simulators, and they're very effective. They work. But one of the things that really started to happen and that created the switch for me, that backtesting simulator couldn't. Not to say a backtesting simulator is not effective, but it's the concept of collecting samples. Collecting samples of your strategy, collecting samples of the things that you're looking at in the market and you're trying to perfect. And I think a lot of traders are struggling with that, where it's like you're trying to build a consistent strategy, but you don't have the understanding of that strategy. You haven't collected enough data on that strategy. You have to do the collection of data. So this series here is going to be, at least this first one, it's going to be a breakdown of the accumulation and distribution. You may have understood it from some of the other videos. You see me use it live in my live trading videos, and I may have done one or two videos of it in the past. This one is going to be an ongoing series where I'm going to be showing you different samples. We're going to be going over that, and as you watch through this video, that's what you can do. You can collect samples of this particular strategy, go test in the market, see how it works, whether you're trading gold or whether you're trading a different market. Or this is also something that you can take, or an approach you can take to your particular trading style and do the same thing. So when it comes to accumulation and distribution, the very first concept of it derives from the different market states, right? And the very first thing you want to understand when it comes to understanding accumulation and distribution, because I know that term may be familiar to a lot of you guys, to some of you may not be familiar. We're going to go into it, but you have three different market states, right? You have a trending market state, right? Price making higher highs and higher lows, right? From a market structure standpoint, buyers are dominant, right? And obviously, my concept of buyers and sellers and how they're constantly fighting for struggle and fighting for power, and in the process they're targeting the highs, right? And then when sellers come into the market, right, this is a second market state where Price is moving lower and sellers are dominating. When neither of these are happening, you will get a range bound market, right? Which is prices essentially just going sideways, right? Not particularly going in any direction. There is no trend. And you can also call this a range bound market. You can call this a consolidation. You can call this a sideways market. This concept is where accumulation and distribution is originated from. And I'm going to break down why I started to call it accumulation and distribution in a little bit. But this was where I would lose a lot of my capital when I was learning how to be a consistent, profitable trader. From a market structure standpoint, it is easy to make money when the market is going up because you can be a buyer. But when price is going lower, boom, you can also do the same thing as well. Now, the tricky part is when price goes into a range, a lot of traders, myself included, was losing money. And I'm like, well, how can I make a profit if I make a lot of money and then I give it all away during this range? I didn't have exactly a strategy to trade that. So I started to notice and I started to work on this aspect of my trading a bit more by studying my losses, by studying my losers, and by studying the reason why I am losing. And this is one thing that you can do for yourself as a trader to make yourself better. Your losses are a part of the journey. Your losses it's what is going to get you from point A to point B. The reason why you're losing and not ignore it, I guarantee you in a shorter period of time than you think, you can become consistently profitable. But a lot of the things in life that we are avoiding is actually the solution to the problem. And I started to look at this and I'm like, well, if I lose money in consolidation markets, rather than trying to avoid consolidation markets because sometimes you didn't know when a consolidation market would come into play, how can you capitalize on it? How can you make it a part of your overall system? So rather than you making money during these market conditions and losing it during these market conditions, how can you make money during an uptrend or a downtrend and an uptrend, and then also make money during the consolidation as well? And then I started to dive deeper into this overall concept of why is a sideways market happening. This goes into the concept of buyers and sellers. Buyers and sellers are constantly coming into the market because there is constant flow of liquidity. When money is flowing into the market and it's moving in a particular direction, whether it's to the buy side, it's not because of support resistance. It's because buyers are coming into the market and liquidity is flowing in that direction. Same thing to the downside, right? Sellers are coming to the market because there's more liquidity flowing to the downside and they have the objectives that they're reaching for. Does that mean that the liquidity dies down during this period? And a lot of people will say, yes, consolidation market, as I knew it, my first couple of years of trading was no liquidity, lack of volume, and so on and so forth. That was my basic understanding, and it is not wrong. In certain situations, at certain time of the day, the market will go into a range. You will also see the market go into a range plenty of times where it's not low volume. The time it's not out of session, right? It's not in the Asian session when there's no liquidity or there's no volume in the market. And even during that period, there is still liquidity. There's still orders flowing into the market. The currency market is global. The stock market is also global as well. It may not be open 24/7, but when you're looking at forex as a whole, you're looking at commodities, we're taking a look at gold. These are very liquid instruments. There is constant flow happening, constant transactions happening from the big institutions, the bank, the hedge funds, the commercial traders, right? The central banks. There are very rare times where there is not liquidity because money is constantly moving. So even in the market state like a sideways market, it is not because there is no liquidity. It is simply, there is always money flowing in and orders are coming into the market. So when I started to realize, one, the consolidation or sideways market is not low liquidity. That's the first thing to understand. A sideways market or a consolidation market is not low in volume or low in liquidity. It is the accumulation of orders that are coming into the market, waiting for the right time to be distributed to its predetermined level. Sometimes the market state is going to be trending. It's not going to trend forever. Nothing goes forever. Sometimes, momentum stops, consolidates, and then this is what we have when it's happening. Because you look at the global market, you look at the currency market, right? You got the London session, you got the Asian session. This means that when the London session is open, the New York session is open, right? When the London session, the New York session is closed, the Asian session is open. There's always liquidity. There's always money flowing in, right? So the concept of, there's not enough liquidity, it's just not the right time. But orders are still coming into the market, but these orders need the right time in order to be distributed. So you can put in orders at a particular time, buyers come in, sellers, but when there is enough orders that come into the market, that's when you get the big push to the upside. And that's the concept that I started to pay attention to and realize, well, after a price accumulates, why does it then just shoots up or shoots down? Right, depending on the direction, because I started to realize this is an accumulation of orders. If you're watching, let's say maybe a superhero movie or something, and someone has a superpower of their abilities, they can accumulate power, and the more power that they accumulate, right, the stronger they're able to distribute that power. It's the exact same thing here with accumulation and distribution, right? Orders are coming to the market is moving sideways. That's what you see it as. But what's really happening, orders are constantly flowing into the market. The market is never quiet. The market is never, dead, even when it appears to be, because this is a global system, right? This is how the system keeps running. Money is constantly circulating. It's just the time, right? And price is waiting for the right time to distribute that. So I realized, okay, a sideways market, a consolidation, a range-bound market is not just a range-bound market from a technical price action standpoint. You got to read more into it and try to understand what is going on behind the scenes. And when you start to understand that the market is always moving, money is constantly flowing, and that is what drives price, liquidity, not support resistance, not market structure, money. And money is constantly flowing into the market at all times. So it is just a matter of understanding, okay, well, when is price going to distribute? When is the market going to move in a particular direction? And price would do that after enough orders, enough liquidity, whatever has been flown, that's come into the market, and then price essentially pushes higher. This is where, this right here is what we call an accumulation zone. That could be, I could have spelled that wrong, but my spelling is not that great, but I do okay. That could be right. I'm pretty sure it is right. Accumulation zone. This is what you would call an accumulation zone. It's the accumulation of orders that are coming into the market. And this is not just like an institutional thing. This is not a smart money thing. This is just a basic understanding of money is what moves price. Even when the market is going sideways, it is still accumulating money. It is still accumulating liquidity. It is still accumulating orders that are flowing into the market. And when these orders are accumulated, at some point in time, they will get distributed. This is where the accumulation and distribution concept comes into play. A big part of the concept is you wait for price to accumulate, and then you wait to get the distribution, and sometimes it could just be a simple candle that breaks above, or multiple candles that breaks out of this level. This would be the first sign as a retail trader that gives you insight as to where price is going. And then what you wait for is a retest back into this accumulation zone. You understand supply and demand, you understand support and resistance, and you can also understand that when price trades back into a level that it previously traded away from, that was strong, that the market had multiple difficulties breaking through like this, and it finally broke through, you understand that this level is going to hold a lot of power. This is where we capitalize and we look to take price to the upside if price breaks to the upside, right? This is the concept of accumulation. First, minor distribution, you wait for the retest, and then you get the real distribution to the upside, which is what is, going to allow you to execute your strategy effectively. So now let's take a look at a few examples that are going to give us more insight in terms of real time. If we take a look at gold, the one thing you have to understand is this is a strategy that you will see across multiple different time frames, and it is the exact same approach, the same way you apply it. The more you see it, the more you will recognize it, the more you'll be able to utilize it. Even as I'm taking a look in the market right now, I can even see one. This was not even an example that I was trying to give, but there you go. You have an accumulation zone right here. Orders came into the market, and it didn't distribute right away. Call this the accumulation zone. Why? Because price was simply moving sideways, right? It wasn't a strong accumulation zone. It wasn't massive, but this is still good enough, right? This was, even though the market was still making lower lows and lower highs, technically, it doesn't mean that price is just not going to, break below the level. That's not what it just means that price is still playing within a particular range, playing within this range. And what we see here is we got the first minor distribution, and then boom. So this played out during the Asian session. So this is also the power of it, that it can happen, and it's something that can be utilized on multiple different sessions. I use it mainly in the New York session because gold moves a lot more during the New York session, but you can use it. You can find samples of it in the London session as well. Let's go over to take a look over here on the chart. If we take a look at this example here, we go right here. So this would be a classic example of price essentially moving in a range bound market, right? You can see that clearly, that price is, going up, going down, up, down, up, and then it's moving sideways. So that this is an accumulation zone, and what this tells you as a trader, eventually the market is going to move, the market is going to break out, right? Consolidation, breakout, boom, that's standard. But what's happening is orders are coming into the market. And the cool thing about accumulation and distribution is once you apply certain things like market structure, you still have to do your entire daily time frame, right, bias and your analysis to understand where price is going. And what we see here is that overall the market is in an uptrend. We started to consolidate, right? So generally what happens with an accumulation and distribution is it is ideally best to use it with the higher time frame trend. If the market is up and buyers are dominant and you start to see price essentially move to the side, it is always better to take the trade or to look for a breakout above. If price breaks below, it can still be very, very effective. It just means that the probability might not be, as high as if you traded it during the trend. So taking a look at this example here, what we see is we have an accumulation zone. We're seeing price essentially do its thing, boom. So right there, what do you see? 8 a.m., right? 8:40, we've seen price break out of the zone. Price has been accumulating since I believe it is Thursday. For the last 48 hours, we have seen the market consolidate and move sideways, but orders are still coming in. That this isn't simply an accumulation zone. And when you get this breakout, right, this is the distribution that you as a trader, you're simply looking for. So when you come into the market and you see something like this, okay, perfect. You have your level, you can, highlight it. You can say maybe right here. I like to place it exactly at the highest point and at the lowest point. That would be from here to here. That is the zone. And what I like to do is sometimes if I'm feeling aggressive, if I'm feeling a little bit certain, I may get involved right with the breakout, but I know that I'm also risking getting stopped out. I break even because I normally take 30 peps on my trade there. So shout out to you guys for say, hey, Manuel says 30 peps. I say 30 peps, man. It may be pep, but it's just the way that I pronounce it, and that's just the game. Anyways, going back to it, we get the breakout. Now you've seen the distribution, right? This is the distribution, and the distribution is the subtle movement that tells you, okay, this is what price wants to do. So for me, rather than trying to guess, because a lot of the time while the market was here, what happens for a lot of retail trader and the orders that are coming in, orders are both buyers and sellers, because you learn that this is kind of like a tug of war. Both sides are trying to control. And what happens with a lot of retail traders is during this period, you're also putting your orders in because you want to capitalize on wherever price breaks out to. I realize that's a sure way to lose, because if you wait for price to tell you exactly what it's going to do, you're going to eventually get your way, one way or another. That's simply just the process here. So what we see is you wait for price to break out. The market breaks out. What we see here, you're waiting. It's still the New York session. You're coming into the market and you're waiting for the bearish momentum to come in, right? And bearish momentum comes in. Now you got to wait for the bearish momentum to die down, right? You're in this zone right now. This is your trigger point, right? So what you have done here is you have analyzed the market, looked at the trend, make sure it's in line with your overall daily time frame in terms of where you see price reaching for. This becomes your execution strategy now. When you come in, you analyze, boom, 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 you wait, price breaks out. This is where your anticipation comes in. You start to anticipate this move. You look, you start to anticipate price to trade back into this level. Okay, whoa, look at that. You don't do anything. That's why I say it is always best to wait for the bearish momentum to die down. This is pretty big. If you bought right here, you would have been in trouble because price traded further down. So this is where you start to say, okay, you know what? We still have a lot of bearish momentum. Let's see what is the market doing here. Okay, now we're starting to see that bearish momentum, fade and more buys coming to the market. You can definitely look and say, well, am I going to get involved? Right there, you have exhaustion on the candlestick. You are also seeing the move. You can be a little bit more patient, less aggressive if you want. You can wait for another candlestick confirmation. And what you see here is essentially price tells you that, yes, more buyers are coming into the market and the bearish momentum is fading. It's worth the risk. You take a long position, you can place your stop loss here. This is a little bit of a larger range here, but you can, set your orders in place. If you got in right here, you probably would have been able to minimize your risk and place, something right here. But this is gold and price moves very, the pip range is very, very wide depending on the time frame that you're looking at. But let's not focus on that. We're going to focus on just the move overall. You can also scale down to the one minute time frame to gain an entry. The process is the same across multiple different time frames. It's just, you place your stop loss at the lowest point, you find a low, you place your stop loss there, you get involved within this range, and you look to target, a level, whether it's a previous high, right, that you have there. Let's take a look. We can say, boom, let's see if price is going to trade up to that high. We also have this high right here that the market is likely going to reach for. So that is going to be your focus when you're looking for price to trade higher. You want the market to target the highs because that's where buyers are reaching for if you're a buyer. So this can be your first target where you look to take something off the table. This is also, another high that we took to the left, and this is going to be the main objective, right? So this is a 1 to 3 in terms of risk to reward ratio. You're risking 1 to make, almost 4 actually. So what we see here is price, boom. Within a couple of candles, price traded out of the zone, boom, right? So you see that. We see a little bit of accumulation here happening as well. So price essentially trades higher again. So this is one example of how you would trade an accumulation and distribution zone. Taking a look at another example here, we have this accumulation zone right here. In terms of pattern recognition, we see price, boom. We have 2 levels actually. You got this level right here, boom. But you know that the overall trend is up right now based on what you see, right? Price is making higher highs and higher lows. So this is where you can decide which one you want to use, right? If you want to be a reversal trader, you can definitely try to, decide, okay, boom, price traded into this level, right? And what you see here is accumulation, right? And it worked both ways, and what eventually happened is price started to move to the downside. You would have made profits. You would have made money. You got the distribution right here, and then you waited for price to trade back into the zone, and then you sell, and price essentially trades back into this level. But now, since the market is in an uptrend, guess what? The market doesn't keep falling because this is also a pretty decent level as well, right? This is a decent accumulation zone, and the market essentially bounced up and does its thing, consolidates for quite some time. I believe it's doing right now, and then before we see the market trade away from this level. So price is consolidating, and doing that. So overall, this level has done its thing, and the market essentially moved away from that. We also have another accumulation zone right here, right? This is also another accumulation zone that the market has just formed, and now we're seeing that distribution back in. So what do you think price is going to do here, right? This is a pretty strong accumulation zone, right? You wait for orders to come in, you wait for bearish momentum to come in and more buyers to come into the market. You can put in your buy trade right there. As price is trading out of the zone, you can do about 30 pep and see where price trades up to, and what you see there is the market essentially trades away from that level. So the market is in a constant state of trend accumulation, trend accumulation, trend accumulation. That's how the market moves, even during times of liquidity, right? So the concept of like, hey, accumulation zone, the market is consolidating, the market is moving sideways, there's no liquidity. A lot of traders just stop looking at the market. They stop seeing it as an opportunity. And what I want you to understand is when the market is moving sideways, if you understand this, it could be one of your biggest opportunities. Whereas everybody is, okay, either just not looking away, looking at a different market. This is where you wait. You start to anticipate, okay, you get this move, break to the upside. Price wants to go up. If the market goes up, right, this is the first sign that the market is going to be moving to the upside because it broke out bullish and then traded back into the zone and then boom, right, and continued its up move to the upside, right? You could have taken something off this trade, but those are 3 examples that I've given you, or in just this time span, came up with one, and then we saw 2 more that played out plus the previous one. So accumulation and distribution is extremely important to understand because it is a market. It is a very fundamental state of the market that you can capitalize on. For me here, I'm not big on teaching you generating concepts. I am a firm believer that there is nothing new under the sun, and all these concepts that are on YouTube all over, whether it's smart money concept, whether it's another new trader coming in and telling you that this is the concept, this is my concept, it's all derived from something else, right? It is all derived from the most simple aspects of trading. If you understand the basics, you can understand pretty much anything, and that is all you need. Accumulation and distribution is a basic aspect of trading. It's the same thing with the buyers and sellers concept, right? It's all derived from price making high highs and high lows, and this is derived from price moving sideways. But the number one thing that you have to understand, which I feel like is the disconnect for a lot of traders, is they don't understand what drives price. They think price is being driven by all these technical tools. Money drives the market. If you can understand that money drives price, you can start to come in and you can see behind the scenes that if money drives the market, and money, the currency market is made up because of the global transaction that is constantly happening, and the system is forever flowing, right? There is never a shut period of time where money isn't moving. You start to understand that a sideways market is not a low liquidity market. There is always liquidity flowing. If this was stocks, this might be a little bit different, right? If this was a different market, but this currency game, the commodity game is derived from our overall system, our financial institution, our financial system that is currently in place right now, and it is a forever moving. So that is the number one thing that you have to also maintain, that perspective that your overall trading is part of the financial system that is happening. You still have to see the market from that standpoint, and then once you see the market from these big institutions, it is a money generating machine, right? And it is just telling you what is going on globally, and you start to look at the technical aspect. You understand that, okay, money is constantly flowing in. The accumulation and distribution is just a reflection of that. So it's not a smart money concept. It is not a, oh my God, this is a powerful life change. It is life-changing concept. It changed my life, with the amount of money I've been able to generate with this, particular concept. But it happened once I understood it. And it always is important to understand the foundational aspect of it, because price action is derived from that simple aspect. So this is the first series. I'm going to create some shorter videos where you can understand, a little bit more. I can show you some more examples, and that is going to come in the next couple of weeks. In the meantime, if you guys do have any questions in regards to this, certain things that you don't understand, certain things that, maybe, you're a little bit out of touch with, you can definitely leave a comment down below, and I can maybe touch on it in the next videos. But what you can expect now is shorter videos that is going to be a breakdown of the samples. It's the concept of collecting samples. This is the one thing that really helped me as a trader, to go in the chart, screw back testing. Back testing, trading, $100,000 in the back testing and buying and selling, that's doing nothing for your brain. It's not going to translate. This right here is going to translate more than 100 hours of backtest simulator, because things are moving so quickly on the simulator. You have no time to recognize any patterns. But if you can go into the market, you know exactly what you're looking for, and you're able to collect 100, 200 samples of this, I guarantee you in real time, you will feel more comfortable putting your money into it than anything. And that's one of the things that changed for me. I am not afraid to execute when I see my strategy, because I know that I have collected hundreds of samples on this particular subject. If I lose, okay, this is just that one random one that didn't work out. That's okay. But when tomorrow comes and I see it, I'm just as excited because I'm executing on it. But that happened when I started to collect samples. So I'm gonna go over some other examples in the next little bit. You can expect some other videos. You can expect part 2 to be a lot shorter than this, but I just wanted to give you the breakdown of the overall concept. And yeah, if you guys have any questions, feel free to let me know. Hope this makes sense. Don't take my word for it. Take it to the chart. That's always what I say. That's the whole point of this. If you're not going to take it to the chart, then don't leave a comment down below. Once again, thank you guys for watching. Hope you found this insightful. It's Emmanuel from LiveFree FX. Until next time, hope you're out there living free. Cheers.